Hi everyone, welcome to the session. In this session, I'll be discussing about a question relating to standard costing and variance analysis. Okay, so let's go through the question, then we'll move on to the solution. Royal PLC, a manufacturing firm, it makes a single product, Roya, using a single raw material, rose. Standard cost relating to Roya have been calculated as follows. Okay, so you have been given the standard cost information for a single product called Roya. Standard cost schedule for Roya, direct material rose 100 kg at 500 per kg. So the total cost per unit, the direct cost per unit is 50,000, which is this product requires 100 kg at the rate of 500 per kg. Direct labor 10 hours at 800 per hour. So this unit, this product requires 10 hours at the rate of 800. So therefore per unit labor cost will be 8,000. Variable production overhead 10 hours at the rate of 200 per hour. So which is 2000. So therefore the total standard cost will be 60,000 per unit. So this is the standard cost or the plan or the budgeted cost of Roya per unit. This is the per unit cost. The standard selling price of Roya is 90,000. And Roya PLC budget to produce 1,020 units a month. Okay, as you can see, the selling price per unit is 90,000, whereas standard cost of producing one unit is 60,000. So therefore, selling price minus standard cost will be the contribution. So this is the budgeted contribution. Okay, so which is 90,000 minus 60,000 will be 30,000 will be the budgeted contribution. Okay, so let's move on to the actual details now. During December 2020, 1,000 units of Roya were produced. How many units were produced? So this is the actual production, whereas this is the budgeted production. Relevant details of this production are as follows. Direct material for rose information is given. 90,000 kg costing 72 million were bought and used. So the company has bought 90,000 kg and the cost was 72 million. Okay, so under direct material, now we discussed in our previous sessions, we need to calculate two basically variances, which is the price variance and the usage variance. So as far as the price is concerned, we need to compare how much used. Now, how much should have been used? We should have used. Okay, so these two we need to compare. As far as this 90,000 kg is concerned, the company has paid 72,000. So therefore, 72 million. So 72 million they have paid, used. So in order to purchase this 90,000 kg, how much they should have paid for this? Okay, which is 90,000 they bought, but our plan was to pay 500 per kg. Okay, this was our plan. So we should have paid at the rate of 500. So basically, 90,000 kg times 500 per kg will be 45 million. Okay, so therefore we have a price variance of, there's a difference of how much? 27 million. 27 million. This is adverse or favorable? We should have paid for 45 million. However, we paid 72 million. So therefore, this is an adverse variance. So this is a price variance. How about the usage variance? So usage variance also, we have to compare two things. How much used in kg, okay? How much we should have used in kg. Okay, so as you can see, we used 90,000 kg. Okay, to produce 1,000 units, right? So to produce 1,000 units, we used 90,000. How much we should have used? So as you can see, we plan to use per unit 100 kg. So therefore, for actual production of 1,000 times 100, how much? 100 means 100 kg per unit. So to produce 1,000 1,000 units, we should have used 100,000. So therefore, there is a 10,000 kg difference times our standard cost is how much? 50,000. So if you use this 10,000 times 50,000, so that will be how much? 5 million. Is it favorable or adverse variance? So it should be a favorable variance, because we should have used 100,000 kg. However, we used 90,000 kg to produce this 1,000 units. So therefore, our variance is favorable 5 million. Is that clear? Okay. Now let's move on to the other one, direct labor. Okay. So direct labor, let me use a different color. 8,200 hours were worked during the month, and the total wages were 6.3 million. Okay, so even under direct labor, we need to calculate two types of variances. One is rate variance and efficiency variance. Okay, even rate variance, we had to compare how much we have used or we have paid in terms of the value, the rate, and how much we should have paid. How much we should have paid. So this is what we need to compare. So as far as the rate is concerned, we have paid 6.3 million. Okay, so we paid 6.3 million. So we should have paid for 8,200 hours of work. Okay, actual hours 8,200 we have worked. Our plan was to pay how much? 800 per hour. This was our plan. So if you take 8,200 times 800, so what will be the value? 8,200 times 800, so that will be 6,560,000. So therefore, we should have paid for this 8,200 hours 6,560,000, whereas we paid 6,300,000. Okay, so therefore it's a favorable variance of 260,000. Okay, so rate variance is favorable to 60,000 because we paid only 6.3 million, whereas we should have paid 6,560,000. So therefore, the variance is 260,000. It's a favorable variance. Okay, now the efficiency. So efficiency variance also we need to calculate how much was used in terms of hours, how much we should have used. We should have used how many hours? So used hours, how much? 8,200. How many hours should I have used? We should have used how many hours as per the plan? We were planning to use 10 hours. Okay, so 10 hours for 1,000 units. So we were producing 1,000 units times 10. So that will be how much? 10,000. So 10,000 minus 8,200. So that will be 1,800. 1,800 times what was the standard rate? Standard rate was 8,000. So therefore, so in fact, this should be 800. Now let's move on to the variable production overhead. So variable production overhead, the actual cost for the month was 2,500,000. Okay, so basically variable production overhead also consists of two types of variances: expenditure variance and efficiency variance. So basically we had to compare on the expenditure variance, how much was used, how much we should have used. Okay, should have paid or used. So how much we paid? Actual cost for the month was 2.5 million. So 2.5 million was paid. So how much we should have paid? So variable production overhead, we need, our standard requirement was 10 hours at the rate of 200 per hour. So now during the period, we have used 8,200 hours and we absorb the variable production overhead at the rate of 200. So therefore, 8,200 times 200 will be, that will be 1,640,000, I suppose. Yes, 1,640,000. So therefore, we paid 2.5 million, whereas we should have paid 1,640,000. So therefore, the difference is 860,000 Is it favorable or adverse? I think it's an adverse variance because we paid 2.5 million, whereas we should have paid 1,640,000. So therefore, we have paid more. We have used more. So therefore, it's an adverse variance. Now, efficiency variance also, we have two types in terms of hours, how much we have used and how much we should have used in terms of the number of hours. So basically, uh, the used, so if you take the efficiency variance, used, how many hours used? 8,200. So it is given here, 8,200. How much we should have used? How much we should have used? So we are, our actual production is 1,000 units. It's given 1,000 units. To produce 1,000 units, we need how many hours? Variable production hours? 10 hours. So therefore, 1,000 units times 10 will be 10,000. So the difference is 1,800 hours. So 1,800 hours times 200, which is our standard rate, standard cost rate is 200 per hour. So therefore, that will be how much? 1,800 times 200. So 360,000. So that will be 360,000. Is it adverse or favorable? Because we used 8,200 hours, our plan was to use 10,000. Therefore, it's good. It's a favorable variance. So expenditure variance was adverse, whereas efficiency variance, variable production efficiency variance is a favorable variance. Okay. Now we have calculated three main variances: direct material, then direct labor, and variable production overhead. Now, in addition to that, you are given inventories of the direct material rows are valued at the standard price of 500 per kg. Okay, so that is the cost as per plan. Okay, so that is 500 per kg. Each roya was actually sold for 97,500. The actual contribution was 60,700,000. Okay, so basically you are required to calculate the following for the month of December 2020. So which is variable cost, variable production cost variance, direct labor cost variance into rate and efficiency variance, direct material cost variance into price and usage variance, variable production overhead variance, analyzed into expenditure and efficiency variance. Then you have selling price variance, sales volume contribution variance, and then determine the operating statement for ROIA for the month of December 2020. So these are the requirements. However, we have calculated these main variances we calculated. Okay, direct labor rate and efficiency, direct material price and usage variance, and variable production overhead expenditure and efficiency variance are also calculated. Okay, now we need to calculate basically the cost variances. Okay, so and variable production cost variance and variable production overhead variance. So this is a total production cost variance. Okay, so let's move on to the variable production cost variance. So if you take this, the variable production cost is 60,000. So variable production cost variance, so this is the total production cost. Our standard cost was how much? 60,000, right? Per unit. So we were planning to produce, our actual production was 1,000 units. So therefore we should have paid 60 million. Whereas we have paid, okay, under direct material, direct labor, and production overhead variance. So how much we have actually paid? So this you can take it from here. You are given the actual payment 72 million, 6.3 million, and 2.5 million. Okay, so direct material we paid 72 million, and direct labor we paid 6.3 million, and variable production overhead 2.5 million. So therefore, if you take 72 million, then we have 6,300,000 and 2,500,000. So if you take the total, so that will be 80,800,000. So therefore, our total production cost, variable production cost, okay, variance will be 20,800,000. So which is an adverse variance. Okay, so now basically the rate variance we have already calculated. So direct labor rate variance, we calculated 260, and efficiency variance 1,440,000. Okay, so rate variance is basically 260. It's an adverse variance. And efficiency variance also we have calculated how much? 260 plus 260 favorable, 1,440,000 favorable. Okay, so this is 1,440,000 favorable. So this is also favorable variance. Both are favorable variances. So therefore, the total labor cost variance will be how much? 260 plus 1,440,000. How much? 1,440,000 plus 260. It should be 1,700,000 favorable. Okay, so this should be the favorable variance for the cost variance. So how you can compare that? So basically, we have paid 6,300,000. That is the actual payment, whereas we should have paid 8,000 to produce 1,000 units. Okay, so basically you can calculate to produce 1,000 units, you should have paid 8,000 standard cost, which is I think 8 million. Then we have paid in total 6.3 million. Okay, so therefore the total variance will be 1.7 million favorable. So this is how we calculated. Okay, so this consists of rate variance and efficiency variance. Okay, basically those are the two variances. Now direct material cost variance into price and usage variance. We calculated already. The price variance we calculated, and the usage variance also we calculated. Okay, the direct material price variance was how much? 27 million, and usage was 5 million. Okay, so this is 27 million, and this is 5 million. I think this is adverse, this is favorable. So if you compare these two, that will be 22 million adverse variance. Our cost variance should be 22 million adverse variance. So how do you calculate this? You just compare how much you have paid, 72 million, against how much we should have paid for 1000 units. To produce 1000 units, our standard cost was 50,000. Okay, so therefore we paid 72 million. We paid 72 million, and we should have paid for 1000 units at the rate of 50,000. Okay, so that will be 50. How much is that? 50,000 times 1000. Okay, 50 million. Okay, so therefore this will be 22 million adverse variance. We paid 72 million. In fact, we should have paid for 50 million. So therefore adverse is 22 million. So this 22 million adverse variance consists of price and usage variance. Okay, so this is what we have calculated. Then variable production overhead variance. So already we calculated expenditure variance and efficiency variance. So expenditure variance, how much? So we calculated variable production expenditure variance 860,000 and 360,000. Okay, this is adverse and this is favorable, 860 and 360. So this is 860,000 adverse and 360,000 favorable. Okay, so therefore if you take these two, the total cost variance should be 500,000 adverse. Production overhead variance should be 500,000. So this how we can use. We had to see how much we have paid and how much we should have paid for 1000 units. Okay, we paid 2.5 million to produce 1000 units. 2.5 million was paid. Okay, in fact, to produce 1000 units, we should have paid at the rate of 2000. This was our standard cost. Okay, the total. So total standard cost, we paid 2,500,000 and we should have paid at the rate of 2000. So that will be 2 million. So the total variance is adverse 500,000. So this consists of expenditure and efficiency variance. So basically we have calculated all cost variances. Now we have to move on to the selling price variance. So selling price variance. So as you can see, the actual units. sold was 97,500, whereas our plan was to sell at 90,000. Okay, so if you take 97,500, okay, so actual selling price 97,500, our planned selling price was 90,000. So therefore the difference is 7,500. Our actual units produced 1,000. So therefore 7,500,000 is our selling price variance. Actually it's a favorable variance because our plan was to sell at 90,000, we sold it at 97,500. Okay, now the volume variance, how much we should have used, how much we used and how much we should have sold, how much we sold and how much we should have sold. We sold 1,000 units. Our plan was to sell 1,020. So therefore 20 is the difference times our budgeted contribution per unit is 30,000 that we calculated because our plan was to sell at 90 and our standard cost was 60. So therefore there is a budgeted contribution of 30,000. So that difference times 30,000 will be our volume contribution variance. So that will be 600,000. That is an adverse variance because we were planning to sell 1,020 but we sold 1,000. So therefore our sales volume contribution variance is 600,000 adverse. Okay, now we'll move on to the operating statement. So our budgeted contribution will be how much? Our budgeted contribution will be how much? We were planning to produce 1,020 and our budgeted contribution was 30,000. Okay, so we'll take it in millions here. So 1,020,000 times 30,000. So budgeted production 1,020,000 times budgeted contribution was 30 million. So therefore that should be 30,600,000. So the figure is in thousands. Okay, sales volume variance that we have already calculated. Sales volume contribution variance is 600,000 adverse variance. That is adverse variance. So therefore we have to minus budgeted contribution from actual sales. So that will be 30 million. Okay, so since this is an adverse variance, we need to deduct this. Then sales price variance, we have already calculated. Price variance is favorable, 7.5 million. So we'll take that also. Selling price variance 7,500,000 favorable. So therefore our actual sales value will be 37,500,000. So now we'll take the cost variance into favorable and adverse. Once you adjust the cost variance, you will get the actual contribution. Okay, so we'll take the price variance. We calculated the price variance. How much? Direct material price variance is 27 million and usage variance is 5 million. Okay. So material price variance is 27 million adverse, and material usage variance is 5 million. So we'll take it in thousands. Okay. 5 million. Then we'll move on to labor rate and labor efficiency. So that also we have already calculated. Labor rate variance is 260,000 and efficiency is 1,440,000. 260 and 260,000 and 1,440,000. Okay. So finally, we'll take the variable overhead expenditure and efficiency variance. Expenditure is 860 and efficiency is 360. 860 adverse and 360 favorable. Okay. So once you take the total, okay, if you take the total favorable, how much? 5 million plus 260 plus 1,440,000 plus 360. So that will be 7,060,000 favorable, and whereas adverse is 27 million plus 860. So that will be 27,860,000 adverse. This is total adverse, this is total favorable. So therefore, if you take the net, that will be 20,800,000 adverse. So therefore, 37,500,000 favorable, total actual sales minus cost 37,500,000. So that will be 16,700,000 is our actual contribution. So which is equals to the actual contribution. They have already given 16,700,000. Okay, so 16,700,000. So this is what we have reconciled in the operating statement, considering all these variances. Okay, so we have considered all the variances in this operating statement. As you can see from this, this is the operating statement. We have considered all the variances: sales volume variance, then sales price variance, then we have considered the cost variances, material price, usage, the labor rate, labor efficiency, variable overhead expenditure, and variable overhead efficiency variances. Once you adjust this, you will arrive at your actual contribution. Okay, so this is how you prepare the operating statement.